Welcome back to the Wall Street Podcast. Today we're digging into a new report from Goldman Sachs, dated August 5th, 2025. It's titled, China Banks Addressing Div Yield, Fundamental Change, Risk, and 2Q25 Earnings Expectations. Quite a mouthful, but it basically signals what they see is a key inflection point for China's banking sector. Let's break it down. Okay, first, the overview. Goldman notes Chinese bank shares are up significantly year-to-date, 15% for A shares, 26% for H shares. For Q2 2025, they're projecting fairly modest growth, around 0.3% average for PPOP and net profit. They've also raised target prices, 7% average for A shares, 12% for H shares. Buy ratings kept on CMB, BONB, but interestingly, a sell reinstated on BoCom.
Yes, and a key point the report makes is about dividend yields and fund flows. Now, the current yield, 4.2% for A shares, 5.0% for H shares, are actually below the 10-year median. However, something else is happening. 3-year time deposit rates have dropped quite a bit, down to 1.25%. And this is pushing savers. We're talking an estimated RMB 120 trillion in maturing deposits towards non-bank products. Think high dividend ETFs. So indirectly, this is actually supporting investment flowing back into banks, despite those lower than median yields.
Right, it's a relative yield game then.
Yeah.
So beyond fund flow, what are the positive fundamental shifts Goldman sees? What makes it an inflection point?
Several things. First, asset quality seems to be improving. There's easing pressure from local government debt, and incremental property risks are seen as declining. Retail loan risks, the non-mortgage kind, look manageable. They tend to be shorter term. And crucially, net interest margin, HANI-M stabilization, is now expected sooner than 2026, which was the previous forecast. Also, capital bases look stronger. RWA density, that's risk-weighted asset density, is down from 61% in 2023 to 59% in Q1 2025. That helps support dividends.
Okay, sounds mostly positive. What about the risks? Where should we be cautious?
Well, mortgage risk is still definitely a factor. It really hinges on housing price stability. Any sharp decline could delay improvements in non-performing loans. And then there's manufacturing and export loans, about 40% of portfolios. These face higher provisioning risk from China's anti-involution drive.
That push to reduce overcapacity.
Exactly. That could potentially hit earnings, especially looking out towards 2026.
Got it. And for Q2 earnings specifically, and shareholder returns.
Expectations vary. Revenue growth seems linked to individual bank loan growth. Some banks are guiding for NIM stabilization already in Q2. BONB and PSBC are highlighted for potential asset quality improvements. And for the big state-owned banks, Goldman sees potential for them to raise their dividend payout ratios in the second half by maybe 3 percentage points.
Interesting. Now let's touch on that BoCom sell rating. Why the downgrade?
It boils down to a few things. Weaker NIM and asset quality compared to peers. Lower capital, its CET1 ratio is 11.5% versus the 13.4% average for large banks. Plus, they project a significant 16% drop in dividends per share because of dilution from recapitalization. At a rich valuation, and the outlook implies negative returns.
Okay, that clarifies the report's stance. Let's explore some implications. First, this dividend attraction idea. If yields are historically low, how exactly are they still pulling in significant funds?
It's that push factor we mentioned. The 1.25% rate on 3-year deposits makes even those historically lower bank yields look much more attractive on a relative basis. It forces investors, both retail and institutional, to look for better returns. High dividend ETFs become a prime destination, and they, in turn, invest in bank stocks. It's a reallocation driven by the low-rate reality.
Makes sense. Now, about this inflection point claim, what's the most solid evidence supporting it beyond just the numbers you mentioned?
I think it's the combination of factors. You have policy action easing LGFV debt stress. You have banks themselves signaling NIM stabilization is coming sooner. And you see that tangible strengthening of capital across the board, the lower RWA density. It's not just one thing. It's a convergence suggesting a fundamental shift, a de-risking.
Okay. And looking ahead to the second half of 2025 dividends, especially for the large SOE banks, how firm is that projection for an increase?
Well, the report makes a strong case. These banks have bolstered their capital, even with some dilution. That improved capital adequacy, combined with the lower RWA intensity, means they can raise the payout ratio, say, by 3 points without hurting their capital position or loan growth capacity. It suggests a strategic choice is possible.
So, translating this to the average person's finances, what's the key takeaway?
The big takeaway is that traditional savings in bank deposits just aren't yielding what they used to. Significantly less. This really pushes you as an individual to think more actively about where your money is parked. You might need to explore alternatives, maybe those high dividend ETFs or other wealth management products to get a decent return. It changes how you might approach personal investing.
So a dynamic picture emerging from the Goldman Sachs report on China's banks. A lot changing under the surface. It certainly prompts reflection on how these broader financial shifts might influence your own investment thinking in this evolving market.